now, and a very interesting one at that too, because we're ready for our very first Leaders Dialogue on premium and capital support and the role it plays to move the needle in scale-up climate and disaster risk finance and insurance solutions. Now, this next session will be moderated by Sophie Evans from the Center for Disaster Protection, and her panelists will be Mr. Eric Ruigamba, Director General of the Financial Sector Development Ministry of Finance and Economic Planning in Rwanda, Mr. Ibrahima Diong, United Nations Assistant Secretary General and Director General at the African Risk Capacity Group, Dr. Olivier Mahoul, he's Global Lead and Program Manager at Disaster Risk Financing and Insurance Program at the World Bank and Global Facility for Disaster Reduction and Recovery, Finance, Competitiveness and Innovation. And last but not least, Mr. Ahulo Tupalu, CEO, Pacific Catastrophe Risk Insurance Company. Sophie, over to you. We're all ears.
Thank you so much, and I'm aware we're running late, but what a fantastic conversation to follow up on, and thank you so much to Ekeswei and Professor Banerjee there, because I think we were listening in the green room, not wanting the conversation to end and feeling probably quite anxious about following it up. So welcome everybody, and thank you so much to my great panel that's assembled today. Good morning, good afternoon, good evening from those of us joining around the world. And Lotu, I'm not sure if it's morning or evening where you are in Fiji, but welcome everybody. And I'm delighted to kick off this first Leaders Dialogue, where we'll hear from experts on how to get closer to answering the question, what is needed to move the needle on smart premium and capital support. So welcome to our leaders, as I said, and a few opening remarks from me, and then we'll be diving straight in because I know we are stretched for time. So I believe most of us here are all agreed, if we haven't been working in this area for long enough, that the crisis and disaster risk financing, we need more. We need it to be arranged better, we need it to be in place, and we need it to be supporting those who are living at the front line of climate change right now, as well as those communities who are increasingly vulnerable to climate risk. While a key challenge to scaling risk for disasters and crises has been premium support, it's certainly not the only barrier, which is why we warmly welcome InsuResilience smart premium and capital support premium principles, which I believe were enacted yesterday. So agreeing more funding is needed towards disaster risk financing and climate risk financing to tackle climate risk is vital, but critically it will only be effective if everybody has a seat at the table. In every context, financing must be accessible for a broad range of actors, be it development professionals, national governments, civil society, and humanitarian actors, those who are willing both to deliver impacts and be a positive force for system change. Addressing the question of support for premium financing and capital support must be based on efficiency and sustainability, not just expediency, and we'll be touching on some of those issues today. By working together in an inclusive way, it is still possible to move the needle on climate and disaster risk financing and be a positive force for systems change, but also to deliver sustainable impact for the most vulnerable, with clear governance, transparency, and a real clear idea of how funds will flow to those who need it most. So without further ado then, I'm going to hand it straight over to you, Eric, for some reflections from where you sit in Rwanda and a country perspective, if you will, to kick us off.
Right. Thank you so much, Sophie. Thank you so much, Mr. Secretariat, for inviting me to be part of this exciting discussions. Excellencies, distinguished participants, ladies and gentlemen, for my side, it just gives me great pleasure to attend this new forum, and especially for 2021. I'm very excited and humbled to share our perspective in Rwanda, quite young on this journey, but I'll try to see whether they will be helpful. I must say that we are living in times when the climate change is a global threat, so much severe impact on our economic sectors across the globe, social systems and nature, all affected. These challenges, even the vulnerable countries are not spared at all. So many vulnerable countries are experiencing increased climate change and related disasters, which covers a bit of floods, drought, earthquake, volcanic, and others. These have got severe impact to our lives of our people, property. Some of them also are indirect in terms of losing jobs and loss of revenue. All this mess is happening at the same time when the financial protection gap against climate and disaster risk is still very low. The recent studies show that it's about 90%. That financial gap is about 90% across climate vulnerable developing countries. Now, the mess is happening, the disaster is happening, and the financial gap is low. And so the question remains why, and what should countries be doing? So the reason, especially for vulnerable countries, there are quite many. So some of them is because the financial markets are not developed, and so we don't have much in terms of climate and disaster risk insurance. In other markets, they do exist as financial instruments, but the uptake is very low because people are poor, because the costs of these kind of insurance schemes is very high. In other instances, we see where the governments and government partners are not so much involved. This kind of situation does one thing that leaves many countries with only post-disaster financial instruments. And as we know, they are very inefficient. And of course, they create a lot of pressure on the fiscal policies. The picture I'm trying to draw your attention to is not very different from what was the case in Rwanda. And it was until the time when the government of Rwanda, working with the development partners, decided to develop and implement a national agriculture insurance scheme through a public-private partnership model. And that's what I wanted to share with you, how this scheme was designed with a serious intention and attempt to kind of address some of the smart premium and capital support considerations. Let me just outline a few of those features that we feel that it would be contribute to this debate in terms of what should countries be doing towards supporting smart premiums and capital support. One, from the initial feasibility study, developing the blueprint of the scheme implementation and putting up the team that is meant to implement this. The whole total cost was funded by the government of Rwanda with the support from development partners. And this was done to ensure that the scheme is sustainable to the extent that much of the development was done through public finance, but the real implementation was and is being rolled out through 5 national insurance companies and international insurers. So we feel this would create a bit of sustainability in terms of rolling out this scheme. The second aspect was to look at how do we make the scheme affordable for the vulnerable people and segments of the population, the poor one, who are quite often excluded. The government took a decision to support 40% of the total premiums, and with intention to target the low-income earners. At the same time, the government decided to finance radio frequency identification microchips and the data management systems, as well as mobile applications that are used to onboard farmers under the scheme. Now, with these being part of the features of the scheme, the National Agriculture Insurance Scheme, then you were able to negotiate the premiums from the initial proposal of 6%, for example, for livestock, to 4.5%. And these kind of support from the government, but also from the development partners, we were able to make the scheme a bit affordable for the people that we were trying to target and bring them into this climate and the disaster risk financing schemes. The other aspect you would want to touch on is how do we make this scheme attractive to users from the demand side, but also from the supply point of view. So with 5 insurance companies delivering the scheme through farmers' cooperatives and through credit linkage models, which would involve MFIs and the banks, rolled out across the country, we have seen a discussion starting happening around getting some of the institutions, especially the lenders, to allow to lower the interest rate, because the number of farmers that are using the scheme, and because of the different insurance companies involved, which in a way we have seen it trying to create an impression that the risk that the lenders will be exposed to is significantly reduced. Now, what this has done in terms of market penetration and coverage is seeing farmers that have never been able to access agricultural insurance using it for the first time. At the same time, we have seen out of the 5, 4 of the national insurance insurers, they have never offered this kind of product. And so this has contributed to market penetration and the coverage in terms of the suppliers, but also in terms of the users of the scheme. The other aspect that we think is part of the smart premium and capital support under this scheme is where we see the government of Rwanda providing extension officers to support the rollout of the scheme in terms of educating farmers, but also in terms of creating awareness. Now, the costs of allocating extension officers to every part, especially at sector level, would be very heavy in terms of rolling out this scheme. But when the government covered this cost, what we see is that at least the total operational cost is reduced, which also attributes to and contributes to affordability. At the same time, we see many people kind of getting the skills and the capabilities of using this scheme and uptaking this scheme. We feel without this, then someone else would have been probably added the cost of this awareness and these other activities of educating farmers as part of the premiums. And so we feel as governments, as stakeholders, we have an opportunity to see, to consider extension services in terms of outreach as part of the smart premiums and the capital support. The other aspect that we have seen that is probably important under this scheme is where all key stakeholders, government and non-government, farmer-based organizations, government partners, insurers, and smallholder farmers, and input suppliers have been invited on one table to discuss the needs of the segment we are talking about, to discuss climate risks, to discuss disaster risks, and working together toward this scheme to see how it can address those challenges. And at the end, we must say we are celebrating some bit of decent success in terms of farm accessing the scheme for the first time, in terms of reduced disaster recovery time and increased quality of disaster recovery. We have seen in the past without the scheme where we had floods, and the floods would come and wash away farmers' crops. When that happened, the government, it would take so long time to mobilize the resources and also be able to help farmers recover in terms of food supply and also in terms of helping them with some bit of input for the next season. Under this scheme, the recovery is too fast, the recovery is of good quality, and the recovery is also very speedy. And lastly, we have seen increased resilience to disaster and shocks in the recent time because of this scheme being rolled out to this segment. And of course, I cannot end my submission without commenting on how contingent liabilities for the government have been significantly reduced because of the scheme. So these are some of the few highlights I just want to share with the participants on how the government of Rwanda working with the stakeholders, government and non-government, develop a national agriculture scheme, insurance scheme, and it has quite a number of elements which falls under the discussions. I really want to thank again the organizers, the Secretariat for the partnership, and I hope that some of these lessons and the consideration will be very insightful in the discussion that are going to follow. Thank you so much, Sophie.
Thank you so much, Eric. And I will tell you now that you get an extra present for the phrase contingent liabilities, because you made all the economists around the table very, very happy, and the insurers very happy indeed. So thank you so much for those really helpful, thoughtful insights as we frame the discussion going forward. So, Lottie, as you sit where you sit in the Pacific, we just heard there that smart premiums aren't just about funding premium; it's about everything else that comes with it. From your perspective, what needs to accompany smart premiums and capital support for PCRIP to be successful? You're on mute, sir. Sorry.
My apology for that. Thank you, Sophie. Thank you. Thank you, Secretary, for the invitation to be part of this auspicious virtual dialogue. Greetings from the Blue Pacific. Let me start by sharing some historical information just to help give the listeners, participants, the context of the existence of the company first. As disasters are becoming more frequent and so severe, exacerbated by climate change, the Pacific Finance Ministers in 2007 requested the World Bank to assist the Pacific Island countries developing a program of mechanisms that can provide immediate disaster response finance to strengthen regional resilience in fear of such disasters may raise years of development gains. The World Bank responded positively, and Oliver Mahul know this because he was one of the engineers, and at the same time I was a senior advisor at the World Bank at the time, at the beginning of the concept of discussing of the launching of PCRIP project, a Pacific Catastrophe Risk Assessment and Financing Initiative project that was launched by the World Bank as a positive response to the request from the World Bank. And that had led to the creations of the company, the Pacific Catastrophe Risk Insurance Company in 2016. And that was followed by a decision made by the Pacific Finance Ministers in 2015 annual Forum Economic Ministers meeting. Sophie, about the questions, let me say some lesson learned first. Yes, the insurance program in the Pacific was first started under the PCRIP project that I mentioned, and a pilot insurance program ran for 3 years, so 2013 to 2015, with premium support from the government of Japan. The insurance program was seen as so successful and important for the region that this ultimately led to the establishment of the company to take forward the program, but through an entity established in the Pacific region. But the initial development and piloting of the program was actually only possible due to the premium finance that was generously provided at the time. Some of the key lessons learned on the premium finance arrangements were, first, premium finance is necessary to test new concepts and innovative products such as sovereign product parametric insurance. With such constrained budgets, countries are unlikely to be able to dedicate significant amount towards payment for a new and untested product. Premium finance can provide a way for the products to be tested and build confidence amongst the countries that these kinds of insurance programs can and to work. Second, premium finance arrangements need to be long-term. especially for insurance programs for disaster, which by their nature are not expected to occur frequently. The success of insurance programs like PICRIT can only be judged over the long term. Such programs also need several iterations in order to develop the right combinations of governance, financings, ownership, and products in the regions of concern. So countries need to be supported with premium finance for several years. Otherwise, countries who don't experience disaster over the period of premium finance may start to question the value of the products, while other countries may experience several payouts, as has been the case with Tonga in the Pacific. This requirement for longer-term premium financing arrangement isn't just applicable to the Pacific Island region. The other regional risk pools, as I understood, have all been through a number of evolutions of their business model to find an appropriate approach for their region. This is only possible with long-term thinking and the stability provided by longer-term financing support. Third, premium finance arrangement should not cover 100% of the costs, and country contributions should increase over time. PICRIT still sees it as important that countries also make a part contributions to premium, and that's also part of trying to build ownership of the company. This is not only increases the premium so that the potential payouts of a disaster are larger, but is often the gateway to engaging with countries on the product structures, building knowledge and capacity regarding disaster risk finance, and ensuring the products meet the needs of the countries. Insisting that countries cover part of the annual premium, and that is the proportions increases over time, ensures that the company products are demand-led, which is crucial for the future development of the products and of the company itself. I wanted to also highlight the link of what we are doing from the company to smart premium. I would like to emphasize that the company currently undertaking serious considerations of the importance of the scalable solution to our corporate business, categorizing it into 3 areas. The scale up, meaning that the company now is seen as a policy influencer in the regions within the space of disaster risk finance. Second is scaling out, which means the company can reach out to all sectors of the economy. But the current year, we are just focused on public, meaning government. So we are working towards with the countries in terms of trying to reach out to all sectors in the economy. Lastly, is the scaling tip, narrative that has been, written in many literatures that I have read. That the company it's seen as a catalyst to change the mindset of the Pacific Island countries from being reactive to become a proactive partners when it comes to disaster. So, Sophie, I hope I answer your questions that you asked me, but I know there are other questions that you're going to ask me, which I also prepared something for that. But that's what I wanted to say for the night.
That was brilliant, thank you, and a really, really helpful set of reflections that really, I think, well echoed Eric's intervention there as well from Amanda. So Ibrahima, can I come to you next? And really, I think maybe take the most recent on the very live pandemic that's happening now. How important has premium financing and capital support been for ARC members, especially as they've been managing the risk of the pandemic?
Well, thank you very much, Sophie. I believe Eric and the previous speaker made our life easier by underscoring the value addition of premium financing with regard dealing with disaster risk management, not only in the Pacific, but also in Africa as well. I think as Eric alluded to, disaster with regard to climate change on the continent, it has a face, as a human face, and that is the food insecurity that we see in many African countries, but also community forced to sell their assets to survive. So we're not talking about something that's academic, we're talking about something that's actually real, and lives are lost and livelihood as well. I think second, the best way Sophie, to understand, to appreciate the answer I'm about to give to your question is to understand the business model of our organization is to help African countries to plan, prepare for, and respond to disasters related to climate. On the planning stage, we help countries at least understand their risk profile, with the hope that they can decide either to retain the risk or transfer the risk. And the preparation side, and make sure that the countries are fully coordinated and technically capacitated to deal with disasters. Now, the response side, that's where your question comes in. And that is when the country decides to transfer the risk to the insurance market to mobilize resources so they can actually deal with the communities. That response has to be adequate so that we can actually demonstrate that the whole business model actually works for African countries. When it comes to the response, one of the biggest challenges, obviously, and Eric has mentioned this, is the affordability, the accessibility, and the availability of premium financing. And that is to say, most of the African countries have other competing needs, and sometimes paying for something that may or may not happen. It's not always something easy to make as a case. So what the premium financing has done for us in most of our countries, thanks to the support of Germany, it really allows countries to be able to, at least while they are struggling, to mobilize resources for COVID-related intervention. At least the subsidies being provided help them to actually afford the premium payment that they have to make in order to transfer their risk. And I have seen this with my own eyes. I visited Senegal. Communities are dealing with drought and COVID-19. So you can imagine the two combined is deadly. So therefore, by providing premium financing, number one, we're able to at least help the countries to actually afford the requirement of premium financing. But I think, Sophie, it does beyond just affordability. Our overall theory of change is that if you provide premium financing, you make the country resilient, but at the same time, you're building the ecosystem for disaster risk management in the country. So therefore, the lack of availability and accessibility is such that if we can't actually transfer some of this risk, it affects our theory of change in the long run. It shows to the country there is no value addition to active risk transfer. So therefore, number one, it helps us not only to be able to respond, but also strengthen our theory of change engagement in the countries. Number two, it saved lives and livelihood. Yes, as I said earlier, the countries that I visited in Senegal, if that premium financing was not provided in some of our member states, they may not be able to get the payout. If they don't get the payout, I can let you imagine that the consequences it will have in the lives of many Africans. So therefore, that premium financing has an impact in the lives of many Africans as well. I think the last question I want to address, Sophie, is the importance of capital support to some of to our insurance affiliate of our group. The way our ARC intervene is very holistic. We have an agency that focuses on the risk profiling and the capacity building. We have an affiliate that actually works in transferring the risk to the insurance market. That insurance company, through risk pooling, so we can get better terms from the insurance market. But more importantly, that company has to be viable from a financial and commercial sort of perspective. So therefore, by providing the capital, the way actually the KfW and FCDO is doing, it's our way in making sure at least that company is viable from a financial point of view, so that at least they can actually fulfill their obligation with regard to risk transfer as part of our business model. Obviously, we're always pitching to increase the capital so we can get additional funding for our affiliate, so that in the long run, it becomes a company that's viable and contribute to the overall model of work. Let me stop there. Over to you, Sophie.
Thank you so much, Ibrahima. And I think a really important point, it's not an either-or discussion, which is why I think it's great that InsuResilience's approach, and I think many of us are members of InsuResilience, are really looking both at premium support and smart capital allocation and investment as well. I think that's a really important thing to resonate there about sustainability of the existing platforms and programs that are in place. So Olivier, if I may turn to you. We've talked already today about what has worked, that this needs to be more than just premium subsidy, and also needs to address many challenges, including affordability, but also prioritising the needs of the most vulnerable, as well as additional services that come with insurance, as many of us are aware. So as you sit where you sit now and supporting the number of countries that you do, how do you believe, how are you planning, and you and your team planning, to incorporate much of what's been discussed today into the next phase of the GRIF, particularly thinking about the other principles that we've all signed up to, including things like the pro-poor principles as well, the InsuResilience group. 15.
Thank you, Sophie. I'll try to be brief and also difficult to speak after those practitioners, Ibrahima and Lotu, given their experience. But anyway, let me share with you a couple of thoughts. First of all, I'm going to try to illustrate that in the context of our Global Risk Financing Facility program. As you know, it's co-financed by UK and Germany. It's been in place for 3 years, so still nascent to some extent in terms of the development, but still I think there are some interesting lessons to be learned. A couple of things first I want to reflect on before we dive into solutions. Let's first of all agree on the problem. And let me also put that into perspective. If our objective is really to try to bring financial resilience to scale, it has to be thought in a kind of broader perspective. And we should also acknowledge that this kind of increased financial resilience will be mainly driven by economic growth and economic development. It will be also driven by a proper and sound fiscal risk management. And on top of that, financial solutions like insurance may be a solution. But I think we should be very careful on how we position it into the overall financial resilience agenda. The second point I want to make, again, is just to be very clear that premium and capital support will be a mean, it's not an end. So again, it's very important, like Ibrahima and Lotu said, to clearly identify the development objectives, to clearly identify the potential market inefficiencies, and then also to just justify the role of the public intervention. So in that context, 5 points I like to reflect on. I wouldn't say lessons, again, it's a bit too presumptuous, at least 5 thoughts, highlights I like to make in a few minutes. One is to think in terms of long-term engagement with our partner countries, starting very much upstream with technical assistance. So it's part of a long journey where working together with our partner countries, we can really try to develop technical assistance, exchange knowledge, and then come up with financial solutions. And I think both Ibrahima and Lotu did highlight that. The second point I like to make is the need to mobilize private capital. It's been mentioned multiple times yesterday as well during the high-level consultative group meeting. There are scarce resources, public resources, even more so in the context of COVID-19. So there is definitely a need to mobilize private capital and to make sure that those private investors, to some extent, see those solutions as a business opportunity, not always as a pure development opportunity as part of their corporate social responsibility. And this may be a major change if we can demonstrate the value of those kind of proposals. The third point is, to some extent, will echo what Professor Banerjee was saying before. It's about plumbing. So it's about linking financial preparedness with operational preparedness. We all know that the last mile is the most difficult mile to some extent to do. And to be able to reach out to the ultimate beneficiaries on time is something we know it's quite difficult. And again, in the context of ARC, Ibrahima may be able to elaborate with the contingency plans developed by ARC. But we should not underestimate the need to some extent to develop and link those, I would say, operational preparedness efforts on top of the financial preparedness. The fourth and last point is to make sure that concessional financing, premium and capital support will create the right incentives. And they cannot be thought in isolation. They will create financial incentives, and we need to make sure that this will align well with proper risk mitigation and risk reduction, because it's part again of the broader agenda. So these are some of the lessons I wanted to share with you at this stage. Thank you, Sophie. Back to you.
Thank you so much, and thank you, Olivier, because I think that's an incredibly helpful framing of thinking about it as a much bigger and broader holistic picture as well from where you sit with the GRIF. So I'm aware we are running out of time. We've got a couple of minutes left and much more that we can talk about. So I think maybe we can encourage InsuResilience to have many more of these sessions talking about smart. I think this is the beginning of the conversation. If I may whip round to you all, just very, very briefly, I mean, 3 to 5 words, how you're looking or asking a question of each other, or even asking of that of the audience for support as you sit. Where will you take the smart premium and capital financing work as you all do within your institutions, and where would you like to be this time next year when we redo this session? Lottie, over to you.
Sorry again. Thank you, Sophie. I think we see this such smart premium initiative and capital support as critical to providing crop of thoughts leadership to donor community in this relatively new era. And I think multilateral donor insurers, which Equity aspires to become, offer huge promise in the area of promoting proactive disaster risk management and building disaster resilience. By the promise of MDIs can only be unlocked in an efficient and sustainable manner if there is a crop of consistent and considered approach to premium and capital support. The Pacific Company, just focus on 2 principles. I'll be quickly saying reducing incentives and sustainable impact on the short run. In the short term, over the next 6 months, the company will look how the product can offer a greater impact around the principle 1 and 4, risk reducing incentive and sustainable impact. Currently, the company product is very flexible in how payouts can be used, but there may be ways of incentivizing usage, which can have a more sustainable. Limited fiscal space, as you may have had from Ibrahima, especially since the onset of COVID pandemic, is a key barrier to product uptake. Therefore, premium support could play a major role for the company. So that's what I wanted to add to the questions, and I know that we are running out of time, so thank you.
No, brilliant, thank you. And I think a really helpful thing for us to all rally around and support you and PGRIC as you take that work forward. So thank you. Ibrahima, over to you.
I think, Sophie, what I will say just very quickly is just to underscore that subsidies for premium financing, it's not the only solution for disaster risk management financing for Africa. Unless it's combined with country engagement so you can generate the uptake. Unless you build the contingency planning on the ground, eventually it's not going to be effective. And that has to be said, that the premium financing has to be combined with all the other technical assistance combined so that it can be effective for our member states. I think looking forward, what I like to see is 2 things very quickly. Number one, an organization like ours, we spend a lot of time mobilizing funding for premium support. And that takes away time for us to actually focus in helping countries to basically be able to deal with disaster risk management. So what we'd like to see happen is to have an Africa premium financing facility whereby wherever premium support is required, we can provide the subsidies necessary to build the culture of disaster risk management, with a hope that in the long run, countries will take up their own premium requirements as opposed to coming to for support. And this is picking up very nicely, whereby few donors are coming together to create what they call a multi-donor trust fund. And that would be a game changer with regard to premium financing as well. On smart premium, we're perfectly aligned with the principle of smart premium as defined by InsuResilience. Ultimately, we need to link premium financing with the impact on the ground to see the number of lives being saved, so we can demonstrate that the funding in the long run could have a developmental impact in the way that we can save life and show that the concept work. It's not academic, it's a reality, it's proven, and we can just scaling up so we can reach as many countries as possible. Over to you, Sophie.
This is brilliant, thank you. And I must say I was going to do a summary, but now I don't need to because you were all perfectly summarising for me. So Olivier, the final 2 minutes is with you about taking this action, taking this work forward from where you sit with the GRIF.
So again, just reflecting on what Ibrahima and Lotu were saying, I think it's all about the value proposition of insurance. And as Ibrahima said, it cannot be only about the kind of subsidy part. From a private sector perspective, again, since we need to mobilize additional private capital, those kind of products have to be attractive to the private sector. So you need to create some sort of sustainability around that. On the other hand, from a development perspective, I think it's very important to sell insurance beyond just providing financial support in case of a disaster. All about transparency, discipline, efficiency that the insurance systems themselves can provide, I think as valuable as the insurance payout. And it goes back to this kind of point made by Ibrahima. It has to be part of a broader conversation about resilience, not only financial resilience, but also physical resilience. And linking in financial preparedness with what I call operational preparedness is quite important. And definitely risk pools, ARC, PICRAFI, CDRFI now in Southeast Asia, and of course CRIF, set up 15 years ago now in the Caribbean, can play a role, can play this link, if you wish, between insurance per se and all the kind of additional benefits that can be offered to the vulnerable countries.
Thank you so much, Olivier. Perfectly timed. Thank you. We'll see you this time next year. Maybe hopefully talking about all of the risk financing solutions that have been put in place with a holistic approach addressing all the incentives and challenges that we had. So thank you so much, and back to you both in the room.
Thank you, Sophie.